I've closed deals where an investor sold a property, walked away with over $1 million in profit, and paid zero in capital gains tax that year. Not through some offshore account, not through a strategy about to get shut down. This is written directly into the IRS tax code, and it's been there since 1921. It's called the 1031 exchange, and by the end of this video, you'll know exactly what it stands for, who uses it, how to qualify, and the rules you can absolutely not break. When you sell an investment property and reinvest those proceeds into a similar property, you can defer paying capital gains tax on the profit. Hear that word, defer, not eliminate, not erase. The IRS is not forgetting about your gain. They're putting your tax bill on layaway while you keep investing. But here's what matters. If you keep doing 1031 exchanges throughout your career, rolling from one property into another, you can defer that bill for decades. Some investors never pay it at all because when a property owner passes away, their heirs inherit at a step-up basis and the accumulated gain essentially resets. That's a whole nother video, but it's worth knowing what's on the table. Here's a concept in real numbers. You buy a rental property for $500,000, it appreciates to $1 million. You get $500,000 in gain. Sell it the normal way and you're writing a check to the IRS, depending on your bracket, that's $80,000 to $150,000 gone before you reinvest a single dollar. Now you're reinvesting $850,000 instead of a full $1 million, and with a 1031, you roll the entire $1 million into the next deal. Every dollar keeps working. That gap, capital compounding for you instead of going to the government, is how real estate investors build generational wealth. Not just by buying smart, but by keeping their equity the whole time in every single deal they move it. Now, I'm Justin Ferguson, commercial real estate broker in Virginia. Let's get into it. This is not just a tool for institutions, individuals, LLC, corporations, S corps, partnerships, trusts. Almost any tax-paying entity that owns investment or business real estate can use a 1031 exchange. If you own a rental property right now, you're potentially eligible. The key word is investment. The property has to be held for investment purposes or use in a business. Your primary residence does not qualify. The vacation home you use personally throughout the year does not qualify. But a rental property, a commercial building, raw land you're holding for appreciation, a self-storage facility, a multifamily apartment complex, all of those work. Here's where most people get surprised. The IRS uses a term called like kind, and most assume the replacement has to be basically identical to what you sold. Not true, at least not for real estate. The standard is actually very broad. You can sell a single family rental and exchange into a strip mall. You can sell a vacant land and buy an apartment building. You can swap a duplex for a commercial office building. As long as both are real estate held for investment or business use, the IRS considers them like kind to each other. You're not locked into the same property type. What you cannot do is cross asset classes. No exchanges real estate into stocks, bonds, or securities. No partnership interests. The exchange stays within real estate, but within that lane, you have real flexibility. One important caveat, IRS looks at intent. Property you're now flipping or holding as resale inventory typically does not qualify. The property has to be genuinely held for investment, not for sale. The two deadlines you cannot miss. This is where exchanges fall apart, so pay attention. A 1031 has two hard deadlines. The IRS does not grant hardship extensions. Missed either one and your entire deferred gain is fully taxable in the year of the sale. No negotiation, no grace period. Deadline 1, 45 days. From the exact date you close on the sale of your original property, you have 45 calendar days, not business days, calendar days, to formally identify the replacement property in writing, signed by you, delivered to a qualified third party. That means the seller of the replacement property or your qualified intermediary, which we'll cover in the moment. Here's what doesn't satisfy the requirement. Telling your real estate agent broker, emailing your attorney, calling your accounts. It has to be a formal written identification to the right party, and the property has to be clearly described, a street address, a legal description, or a distinguishable name. Vague does not cut it. Deadline 2, 180 days. You have 180 days from the sale to actually close on the replacement property, and it has to be substantially the same property you identified in the first window. You cannot identify one property and quietly swap it out for something else at day 150. And here's what trips everybody up. Both clocks start on the same day. The moment you close on the sale, the 45-day and the 180-day clocks both start. If you wait until day 44 to identify, you only have 136 days left, not 180 more. So build your replacement property timeline from day 1, not day 44. Here's a rule that catches first-timers completely off guard. You cannot touch the money. When you sell your property, the proceeds cannot pass through your hands, cannot go to your bank accounts, cannot be held by anyone with an agency relationship to you. If that money hits your personal account, even for a single day, the exchange is disqualified and your full gain is taxable immediately. No grace period, no appeal, no exceptions. The funds go directly to a qualified intermediary, QI. This is an independent licensed third-party company whose sole job is to hold your proceeds in escrow from the day you sell until the day you close on the replacement. When you're ready, the QI releases the funds to close the deal. You cannot be your own QI. Your real estate agent can't do it. Your attorney cannot serve as your QI if they represented you in any capacity within the last 2 years. Your accountant falls under the same rule. It has to be a fully independent third party with no prior buyer-agency relationship. Here's a real risk that doesn't get talked about enough. QIs are not regulated like banks. There's no federal insurance on those funds. Those are documented real-world cases of intermediaries going bankrupt or misappropriating client money while holding exchange proceeds, leaving investors facing a tax bill and a financial loss at the same time. When you're picking a Q1, treat it like vetting any significant business relationship. Ask whether your funds are held in a fully segregated account or pooled with other clients. Ask about their bonding and errors and omissions insurance. Do not skip that diligence. Your basis in the new property. See, in a 1031 exchange, you did not get a fresh start on your tax basis. The basis of the replacement property carries over from what you sold with some adjustments. That deferred gain is now embedded inside the new property. The IRS hasn't forgotten. It's just sitting there waiting. And what that means practically, your depreciation deductions on the new property will be lower than if you had purchased it outright because you're starting from a lower carried over basis. And when you eventually sell in a taxable transaction, all that accumulation deferred gain, every dollar rolled forward across every exchange, comes due at once. Basis tracking is not optional, it's a legal requirement, and errors compound badly across multiple exchanges over time. Your CPA needs genuine 1031 experience, not just general real estate tax knowledge. The IRS reporting done on Form 8824, and it requires detailed documentation of both properties, transfer dates, cash exchange, liabilities assumed, and your adjusted basis going in. The right people around you before process starts, not after. Here are the three structures and the three ways this actually gets set up. First, simultaneous swap. Both transactions close on the same day. Simplest in theory, rare in practice. Synchronizing two separate closings on the same date is a challenge most investors don't pull off cleanly. Second, and by far the most common, the deferred exchange. You sell first, your QI holds the proceeds, you identify within 45 days, and you close within 180. This is what most investors mean when they say they're doing a 1031 exchange. And third, the reverse exchange. You acquire the replacement property first before you sold your current one. The new property is parked within a special entity called an exchange accommodation title holder while you go to close the original. You have 180 days to complete that sale. More expensive and more complex to execute, but generally useful when you find a deal you don't want to lose while you're still holding on to your existing asset. A 1031 exchange is one of the most powerful tools available in real estate investing. It keeps your full equity in motion, compounding, growing, instead of surrendering a significant cut to the IRS every time you make a smart move and upgrade your portfolio. But it's not forgiving. The deadlines are hard stops, the intermediary rules are strict, the basis tracking is required by law. Done right with the right CPA and legal team around you, it's a machine for building long-term wealth. Done sloppily, it's a very expensive lesson. Hit subscribe if this was useful. I drop content like this every week covering real estate investing, market intelligence, and the conversations that actually happen in this industry when the clients aren't in the room. Drop a comment. Have you done a 1031 before? Are you considering one right now? I want to hear. Let me know your thoughts.